Great. Thanks, Jerry, and of course thanks to Stuart and his team for putting on a fabulous conference, and we've certainly got a lot out of it, certainly in covering a number of fields. Now, I want to cover a variety of topics, so let me just work out how to make this thing work. No, that's the green button. Oh, it's so simple. A disclaimer that nobody's got time to read. This is essentially what I want to quickly cover, so there'll be a slide or two on each. Recent market movements, so let's just look what's happened over the last 6 months. What are our commodity price expectations? So where do we see particular metals going in which direction? Something we started to highlight yesterday is around this changing electric vehicle demand expectation. So it's all about the expectations and the timing of those expectations, and I think you might be surprised. Lithium demand expectations, something certainly to take home. We'll briefly talk about the FANGs. Now, I know basically that's Facebook, Amazon, Apple, Netflix and Google, but Google's owned by Alphabet, so that's why it's not quite there. Now, there's a few different phenomena that's occurring at the moment that we may not actually understand or may not be visible to us as investors over here, and it's certainly occurring, and it's going to change the landscape going forward. We've got difficulties in achieving outperformance, so that's becoming more difficult, particularly around the fund space. The Van Eck Gold ETF, it's worth just mentioning it because if people weren't across it, what actually occurred. Forward-looking statements, this is sort of ASIC guidelines which are restricting a number of companies, so you as an investor need to understand what the restrictions are there and what sort of information you're being fed and what constraints are there. Institutional research unbundling, this is being pushed out of the UK and out of Europe. It will affect us and it will affect the major institutions, and then a quick summary. So let's get going. All right, firstly, just advertisement on Breakaway. What do? We provide a number of businesses, but the key one here is around research, and we provide 3 products. We provide an investor research product, which is essentially a package that costs $250 a year. If you've gone to our desk, we produce a daily, which is supported by Rob Murdoch's Oztech, and provides a summary of all the ASX announcements the day before in the resource sector, and then we provide a weekly with portfolio recommendations and thematics and so forth. So it's on the website. You're welcome to go and have a look and get a trial and see whether that's of interest or not. We do institutional research. You'll never see this. Funds and companies come to us and ask us to research particular things. An example of this could be a major fund wants to invest in a new IPO. It needs backup research to be able to go to the chief investment officer or the investment committees to be able to justify as to why that fund should invest in a particular company. So that's sort of the bespoke type research that's hidden in the background that we do. And commissioned research. So many of the companies would know that we provide a commissioned research product, and we distribute that across an 18,000 investor database. All right, let's have a look at what the markets have done over the last few months. Essentially, if you look at the Dow, the FTSE 100 and the ASX 200 indices, the Dow has certainly outperformed. Like you can see, these are all indexed back to, actually I can't see on the thing. Back to virtually the start of this 6-month period, and we've read every day the Dow continues to rocket up. It has a few wobbles. From the other indices, you know, clearly the UK has been influenced by the Brexit and a number of issues around Theresa May, of course. And then the ASX 200 has really perhaps gone sideways. You know, it had an outperformance there early on, but then it certainly pulled back with the issue around the banks and the banking levy and the declining commodity prices over the last 2 to 3 months. If we look at larger versus small company performance, so the ASX 200 resources incorporates, of course, BHP and Rio. And then if we look at the 300 metals and mining, we can see basically that the 300 metals and mining is a far more volatile, well, not far more, is a more volatile index, so it'll provide greater upside returns but greater downside returns. So it depends on which part of the market that you're playing with. At the moment, look, you know, they've essentially level pegged over the period that we're talking about. If we look at commodities indices, the CRB index, these are all US denominated. You've got the CRB index, which, you know, covers things like hogs and all kinds of things, agricultural products as well as base metals and other commodities. The LME index, of course, is just base metals, and the S&P and GSCI index is another broad-based commodity index. So you can see that, look, it hasn't been a pleasant time. These indices tended to peak around February, and then we've seen sort of a declining pattern going forward, and particularly around the CRB and the S&P have declined quite severely over the last month or so, and it's certainly going into that summer hemisphere slowdown. The relative performance of base metals, you might be a bit surprised here. So we've indexed them all back to 100. And really, cobalt, perhaps not a surprise, but cobalt's certainly been a great outperformer. But you look at cobalt, and really the performance has been early on. So it's been back around that February, perhaps to March, and then it's more or less, level peg since then. Aluminium, which has really done nothing and has not been an inspiration in terms of investment, has drifted sideways but probably held its pace. Whereas nickel's been rather ordinary, tin's been rather ordinary despite the supply-demand dynamics for tin being quite attractive, and then copper's really just drifted sideways, and zinc also. We quite like the supply-demand dynamics for zinc. Has really done nothing. So when you look at that, perhaps you look there's upside going forward. It's not reflected. If we look at energy stocks and the broader resources index, energy stocks they've been quite interesting. We'll see in a minute with the oil price, but look, again, they've drifted down. We've seen the oil price come down, particularly with OPEC having troubles on getting their act together, and also the shale oil issues out of the US in terms of capping that market. So we've had a bit of a ride with it. At the moment, there's not a lot you can really say there. Perhaps it's matched the broader over the longer term. If we look at the oil price, so the ASX 200 energy index and the oil price itself index, you can see that the shares held up when the oil price did quite a marked drop back in March, and continued on quite merrily on its way. But it's really only recent times that I think people have been a bit nervous around that oil price, and it's started to pull those share prices down. The gold and Dow Jones. I've plotted the gold price, which is in gold here, and the Dow Jones. I've used the Dow Jones because it's perhaps a proxy for the US economy, I suppose, or perceptions of the US economy and the US dollar. So you can tend to see there that, when Janet Yellen is putting up interest rates, or the US economy has some good data coming out, and Dow Jones goes up, the gold price tends to come down. When there's any threat of sort of weakness or away from an interest rate rise, the gold price starts to perform. And look, there's a real Trump factor, I guess, that we were talking about yesterday. And iron ore and thermal coal. Iron ore has sort of drifted down. This is an index. And if we reflect back, there's a lot of iron ore around at stockpiles at Chinese ports. And of course, it's really a China play. So this is influencing our majors, BHP and Rio, as to what happens to this and our balance of trade. But overall, it's a China story. But when you look at the inventories that are around, and perhaps the risk more to the downside rather than the upside of a lot more steel construction, then the risk is more to the downside. Thermal coal is quite interesting. It's just sitting there, and it's good coal companies are generating good cash, and it's hanging around US $80 a tonne, and it's been fine. It just seems to be out there off the radar of most people. And tech metals, a quick look at tech. You can see that lithium had that similar sort of cobalt run, and it's held up there. And I think we'll talk about lithium a bit further. And cobalt, I guess, has drifted sideways since the March time. Okay, markets, a quick summary. Now, you'll recall on copper, we always quite like copper, and it's the bellwether. We've had a lot of supply disruptions earlier this year. You'll remember the Cerro Verde and Escondida strikes. Freeport's still got strikes on at the moment. It's certainly leveraged to increase demand. We've looked at a lot of supply-demand characteristics, and stocks are coming down. It's a bit variable, but if we had an increase in demand, so a perception that the world demand was going to go up, it will drive the price up quite dramatically. There's been LME stock movement gains and falling price on the back of Chinese data looking weaker at some stages. So it's a little bit of a mixed story. It's something to sit back. I think at this time of the year you accumulate copper stocks, tax loss selling and so forth, but longer term it tends to run. Zinc, very encouraging supply-demand fundamentals. The stock levels are incredibly low, and they're just, and it's being held down by a lack of perceived demand. So if that demand, so Trump suddenly decides to rebuild half the bridges in the US, the zinc price will move because they'll all require galvanising and so forth. So there's some real upside there, and it's becoming very difficult to play zinc in the Australian market. Nickel, Indonesian and Philippine supply issues overshadowing. Nickel price has gone nowhere, as you saw before. Lithium we'll talk about in a minute, but the demand is potentially underestimated. Cobalt, again, probably future demand is underestimated. And gold, we talked about briefly about it's dependent on that US growth and US interest rate rises, so how they play out over the next year versus Trump's policies. Iron ore, high inventories at Chinese ports, so no real need to be there, but be prepared that Rio and BHP may not do a lot. Met coal's okay, but again, it's dependent. It's the prices have come back. We had Cyclone Debbie where they all went up quite dramatically. They're now back down to 145 US a tonne, 143 US a tonne, and it's really a steel outlook. So it's obviously linked to iron ore. Thermal coal, politically unsavoury, but again, there's underlying strong demand, so it's hanging there. And uranium, doldrums for a while. All right, overall, just getting on to growth. Look, we're going through a period where there is growth occurring. It's not dramatic. We used to get excited by 3% growth. Now it's less so, and a lot of it's dependent on Chinese growth and Chinese steel demand. If you look at now electric vehicle sales, so something that's a bit more investment focused. I've taken two slides or two graphs from a Roskill presentation that only occurred a couple of weeks ago in Canada. Now, and this was alerted to me and sent across, this is motorisation rate. So what we're seeing here is the number of electric vehicles per ordinary cars, I suppose, and what are the expectations going forward over the next few years? And you can see there's quite a dramatic increase, particularly through China. India's a bit of a lull, but there's a steady increase going forward that we expect people have not fully appreciated. And if you change that to lithium demand, this graph is the first time that we've seen that lithium demand will be around 1 million tonnes at 2025, 2026. Now, I think if you recall Rebecca's presentation with Pepinini yesterday, she had that figure at around 600,000 tonnes. So this is the first time someone's come out, and Roskill are they're like a CRU, they're quite a credible commodity house, and this is starting to get some traction. So people are starting to look at this and think, we're all going to be driving, we're all going to have a second electric vehicle car in the garage sooner rather than later, and I'm talking in the next 3 years as opposed to the next 5 to 10 sort of, or maybe 3 to 5. Glencore picked this up, and this is a slide from about 4 weeks ago, and Ivan Glassenberg, he was obviously promoting Glencore in terms of its commodity mix relative to the BHP in Rio, but he was again pushing that the electric vehicle revolution's happening a lot faster, and metal consumption lies right across batteries as well as charging points in the car itself, and they've gone through and estimated what that consumption's likely to be. So if you start looking, you've got obviously copper, cobalt, nickel. He's talking there about 160 kilograms, and that's copper alone, 160 kilograms per vehicle when you start adding up all the components. So overall, they estimate that in 2020 there could be an additional 375,000 tonnes of copper required and an extra 40,000 tonnes of nickel that really I don't think is out there. Everyone's sort of looking at lithium and cobalt, but they're not looking at some of the basic base metals, I suppose. 2025, although that should be 2025, additional 1.65 million tonnes. So we're starting to get some serious production demand there, and an extra 200,000 tonnes of nickel. And then 2035, where potentially 95% of global vehicles are electric. So when you start looking at those numbers, the real risk is that base metals actually perform quite well, and we're in that sort of lull period where people are just starting to get a grip that this sort of demand may start emerging. I'd just like to throw this slide in. This is really highlighting, and I suppose we've talking about electric vehicle demand, but it's just showing that the waves of technology that when we go back to 1785, what's occurred at various times and where are we sitting. So here we're talking about, the sixth wave, the fifth wave was about digital networks, biotechnology, software, information technology, etc., that we all know about. Now we're going into a range of things, clean tech, renewable. Many of the companies that you've seen here are starting to fall into that wave, and you can see that the interpretation here is that that'll start to peak and start to decline, in that 2025 period. The FANGs. This is so FANGs are Facebook, Amazon, Apple, Netflix, and Google. Although Google is owned by Alphabet. Now, the critical thing here is it's the top line, and I've just fogged it. These are the companies that are dominating the US markets. This is what happens to these things depends on what happens to the Dow, which influences our market obviously the next day. So it's becoming quite remote from the Australian market. And the issue with these companies is that they don't require the capital that historically the companies did. So if we had an Alcoa or something, they were building smelters, they brought in capital. And what we're actually seeing is that some of these markets, like the stock markets, and we're not necessarily seeing this in Australia, is you're actually getting shrinking markets. So if you look at this, these companies do not require the level of capital traditionally associated with capital raisings. Okay, of course, Amazon, generated 136 billion of sales using only 19 billion of invested capital. So you're getting a lot of leverage to that invested capital, as opposed to, like this example of Walmart sales, 486 billion on 135 billion of capital. So you don't have to raise as much capital. Then you start looking at, why are companies floating? Often it's for the vendors to get to liquidate their holdings or to be able to realise their holdings. And then we go through a process of buybacks and dividends and so forth. So this is actually happening. In the US and the UK, the equity markets on a net basis are actually shrinking. So it's quite a staggering phenomenon. So, and you've got more investment dollars going into markets. So the issue here is that, stocks are going to become more expensive. So the yields are going to go down, and it's going to become a more difficult place to actually invest. In addition, how do you outperform? And this has always been an issue with many funds. I suppose last year it was highlighted that passive funds outperformed most active funds in 2016. Increased professionalism in funds management. So you've got this irony where efficient market hypothesis, everyone's playing the same game, so the moment there's some sort of price anomaly, it all gets eradicated. So the ability to actually generate a return like an alpha above the market is becoming increasingly difficult. So that in itself represents a significant problem for all investors going forward. ETFs, I just threw in a slide here, and many of you will know this story. This was the Van Eck Gold ETFs, and they've both been dramatically successful. The key one has been the GDXJ, which is for smaller caps, and it's risen, as I've said there, 225%, or nearly over 3 billion. And people quite rightly invest in ETFs because they think, look, I don't want to take the individual company risk. I'll just buy an ETF and I'll go for a run with the gold price and then I can exit. In this situation, you had a change of mandate. You had the ability, the problem with that GDXJ, it was reaching 20% levels in many of these companies. It had too much of a fund inflow to be able to invest in a market that basically wasn't big enough. It changed its mandate. Everybody saw what was actually happening, so they started shorting the ones that they were going to exit. Bit larger companies that were close to that 1.5 billion mark, and then you start buying the ones that are above that, but under 3 billion because of this reweighting. From a Van Eck perspective, they were simply following their process or their change process. The losers, of course, were the investors in the ETF. Okay, trends in regulation. Last couple of slides. I just wanted to highlight this in terms of forward-looking statements. So the key issue here is that companies have the problem in terms of reporting projects without having a resource at a suitable level that can justify that project. Now, where you end up with a problem is that a company could drill out some mineralisation. It could look like a significant resource that was, potentially capable of supporting 100,000 ounces per annum production over the medium term. It now has a lot of difficulty. Well, it can't actually disclose that because it has to say, okay, it has to meet the required JORC standard for a start, so you've got to spend all the money, drill it out and have that thoroughness around the JORC standard. Then you've got to be able to demonstrate that you actually have the capital or you've got the dilution in your share price to reflect the development of that project so that you can then say you're producing 100,000 ounces. So it has a major impact, and this is going to be increasingly pushed on companies and ASX compliance, and it will create a problem for juniors because at the moment it's very much you look at one of these presenters about what exploration opportunities, where they're at, and you do a probability risk-based analysis, don't you? You think, oh, look, I'll give this guy a 50% chance that he'll be able to pull this off, therefore I'll only pay this particular price. Whereas now, you won't get that description coming out of what the resource potential is. And last, changing patterns of research. I don't want to go into the details, but what it is, it's an unbundling. So if you're now the AMP or BT, you don't... research has been traditionally paid, like from Macquarie or Goldman Sachs or wherever, has been paid through the brokerage. So AMP will buy, I don't know, 100,000 BHP shares. The commission on that, which is ever declining, covers the research component of Goldman Sachs, and it covers the execution capability of Goldman Sachs. That now has to be separated out, or it's starting to be separated. It has to be separated out in Europe, and it's going to influence over here. So what actually happens is that you're going to see this reduction in broad-based research and a much more specialist approach to research, which is going to affect right across the whole board. And in particular, some of the smaller brokers are now going to have to outsource their research because of the conflicts around this unbundling process and also just the general conflicts of interest. So it's certainly starting to tighten up. So anyway, I've taken enough of your time. Look, in summary, it's a lacklustre market as supply increases and Chinese growth is slowing, but remember we're in a tax loss position. Improvements are expected in August, September, October, and I'm quite confident that we'll start to see a rise, and seasonally commodity prices certainly do well during that period and then tend to peak in that February, March the following year. So accumulation in phase during the current weakness is a good idea. Copper and zinc stocks look attractive. Iron ore, coke and coal, manganese, uranium, a little bit of a lacklustre outlook. Precious metals, people are sitting on an overweight or a market weight position in those, but it very much dependent on how the US dollar pans out. We're certainly experiencing another innovation phase, potentially peaking in 2020 and beyond. And those other takeaways, shrinking market phenomenon, difficulties for fund outperformance, that's all going to impact us, ETF risks, which is very real, regulations around forward-looking statements and euro trends, which are going to affect us over the next couple of years. So overall, investors will have to work harder, be more nimble to achieve above average returns and use all the resources available to them. All right, thank you.